If you logged into your 401k this week and felt your stomach drop, you are not overreacting. The stock market is getting absolutely hammered right now. Slow down, wait on hammered, and tariff policy is the match that lit the fire. But here's what I need you to understand, serious, before you do anything with your retirement account. The worst financial decisions people ever make, emphasize worst, happen in moments exactly like this one. So in the next 10 minutes, pace up slightly, confident I'm going to tell you exactly what is happening to your investments, why it's happening, and most importantly, the 5 specific moves you should be making right now to protect your wealth and potentially even come out ahead. Stay with me. Firm, calm. This is important. Let's start with the basics, because a lot of the news coverage around this is either too technical or too panicky. So let me give you the plain English version. Tariffs are taxes on imported goods. When the government slaps a tariff on products coming in from other countries, the businesses importing those goods pay more. And here's the part they don't always tell you on the news. Those businesses usually pass that cost straight to you, the consumer. US food costs alone could rise by 3% as a direct result of current tariff policy. And that's just one sector. But the real damage to your 401k isn't just about prices going up. It's about uncertainty. Markets hate uncertainty more than almost anything else. When businesses can't calculate their costs, they pull back on hiring and investment. Analysts revise earnings forecasts downward, and stock prices fall, sometimes dramatically. Right now, JP Morgan has raised the probability of a US recession to 35%. The S&P 500 has entered correction territory. And the sectors getting hit hardest are the ones most 401k plans are loaded with: tech, retail, and manufacturing. So yes, your balance is lower than it was a few months ago. That's real, and it makes sense to take it seriously. But, and this is the crucial part, what you do next is everything. Before I get to the 5 moves, I have to talk about the one move that will absolutely destroy your long-term retirement savings. And millions of people are about to do it. Pulling your money out of the market. I know that sounds logical right now. The market is crashing, so I'll move to cash and wait it out. Here's why that strategy is one of the most expensive mistakes in personal finance. Missing just the 10 best trading days in a decade can cut your long-term returns nearly in half. 10 days out of thousands. And those best days, they almost always happen right in the middle of the worst crashes. That's not a coincidence. That's how markets work. The recovery is sharp, it's fast, and if you're sitting in cash waiting to feel comfortable again, you miss it entirely. Research from Fidelity confirms what most long-term investors already know intuitively. Investors who stay invested during volatility consistently outperform those who move to cash. Not sometimes, consistently. So we are not pulling out. Now let's talk about what we are doing. All right, 5 moves. Let's go through them one by one. Move number 1, do a real allocation check. Log into your 401k this week, not to panic, but to know. If you set your asset allocation 2 or 3 years ago and haven't touched it since, a strong equity run may have pushed your portfolio well beyond your original target. Here's a quick stress test. Take your current balance. Assume equities drop another 30%. Calculate what you'd have left. If that number would genuinely derail your retirement timeline, not just make you uncomfortable, but actually derail your plan, then it's time to rebalance. Move number 2. Keep contributing, and if you can, increase it. This is the counterintuitive move that the best long-term investors make. When markets drop, your regular contributions buy more shares at lower prices. That's called dollar cost averaging. Think of it this way. If your favorite brand of coffee went on sale 20% off, you'd buy more of it, not less. Your stocks are on sale right now. Keep buying. The 2026 401k contribution limit is $24,500. If you're over 50, you can contribute up to $32,500 with catch-up contributions. If you're not maxing this, a market dip is actually the best time to start. Move number 3. Rotate toward defensive sectors. You don't have to exit the market to protect yourself. During periods of tariff-driven inflation and potential recession, 3 sectors historically outperform: healthcare, utilities, and consumer staples. Why? Because people still pay their electricity bills. They still buy groceries. They still need their medication. These companies have pricing power that manufacturers and retailers simply don't have right now. Move number 4. Revisit your international exposure. This one cuts both ways. Some international markets are actually benefiting from US tariff policy as trade shifts and supply chains reroute. But currency risk is real, and geopolitical uncertainty is elevated. The right move isn't to dump all your international holdings. Global diversification is still one of the foundations of sound wealth building. But review what percentage of your portfolio is sitting there and make sure it reflects where you actually are in your journey, not just your default allocation from 3 years ago. Move number 5. And this one is specifically for anyone within 5 years of retirement. If you cannot afford a 20 to 30% decline in your portfolio because you would genuinely need that money, then protecting your capital becomes more important than growth. Morningstar recommends allocating 25 to 30% of your portfolio to short and intermediate term bonds as you approach retirement. That's not giving up on investing. That's called prudent retirement planning. Here's something worth remembering when everything feels chaotic. Every major market crash in history, let them land individually. 2008, the dot-com bust, the COVID collapse, looked like the end of the world while it was happening. And every single time, the market recovered and reached new highs. Not immediately, but it did. The investors who came out ahead weren't the ones who timed it perfectly. They were the ones who stayed disciplined, kept contributing to their retirement accounts, and used volatility as an opportunity rather than a threat. Volatility is not the same as risk. Volatility is movement. Risk is the chance you can't meet your goals. That distinction will save your financial life. Tariffs are a real economic force, but they are one variable in a very large equation. The US economy is still growing. The labor market, while softening, is still functioning. And corporate earnings in technology and AI are projected to grow 13 to 15% over the next 2 years. This is not 2008. Stay grounded in that. Let me give you your action plan. Before you close this video, first, log into your 401k this week and check your actual allocation. Not to panic, to know. Second, do not reduce your contributions. If anything, increase them. Third, look at your sector exposure and consider shifting a portion toward healthcare, utilities, and consumer staples. Fourth, review your international holdings and make sure they reflect where you actually are in your wealth building journey. And fifth, if you are within 5 years of retirement, talk to a financial advisor about gradually de-risking your portfolio. The people who will look back at this period and be glad they acted are the ones who did these 5 things: calmly, deliberately, and without panic. If this video helped you, hit like. It genuinely helps more people find this content when they're searching for answers. Subscribe if you want more straight talk on investing, passive income, and building real wealth without the noise. And drop a comment. Tell me what you're doing with your retirement savings right now, because I read every single one. I'll see you in the next one.